Okay, hi everyone. Welcome back to the TradeInformer Podcast. This is David, and today we're doing something a bit different, a bit unusual, because for the first time we actually have someone who is more like a trader or an end customer of a broker rather than someone who actually works at one. So Ken Soh, if I'm not butchering the name pronunciation there, is based in London, and I saw Ken's posts maybe a month or 2 months ago, and I thought they were interesting for a couple of reasons. So, firstly, most people who I see posting about stuff like technical analysis or sort of I don't know what to call it, like managed future style trading, tend to be, let's say, not so honest, or just give the impression that they don't really know what they're talking about. And the second thing was actually sort of Ken's background, where he has this sort of long technical background, which I thought sort of added to his credibility. And finally, he actually seems to be crazy because he moved from Singapore, which I think is probably like one of the best places in the world, to the UK, which is the reverse, it feels like, of what everyone else is doing. So Ken, thanks very much for doing this. And maybe to get started, can you just give some sort of background on yourself? Like how you got into trading the markets, and how sort of your transition to doing what I presume is now sort of like a full-time trading your own account type thing.
Sure. Thanks, David. Hi, guys. So I am from Singapore and I moved to London 3 years ago. I have a tech background for the last 18 years. Doing quite well, particularly in the open source digital process automation space. But since the start of my career, I've been investing in stocks, trading stocks. I bought my first share 18 years ago for the Singapore Stock Exchange. And I started off as a retail trader investor for many years. I've gone through the same journey as many successful investors and traders, which you kept paying tuition fees, you kept losing money, and for a while, I was doing short-term trading. I was able to make enough profits, but my profits wasn't enough to cover the commissions and the spreads because I'm like placing like hundreds of trades a month that I'm paying few $1,000s or pounds per month to the brokerage, and I can't cover that. And the more I trade, the more I lose. But around after 10 years, when I slowly transitioned towards a more longer term investing, I realized that the same approach that I've learned over the years actually work much better in the longer term time frame. And I sort of life sort of put me in that position where I'm sort of forced to take longer term trades. I was having my first kid. I don't want to do short term trading anymore. And then I discovered by chance that, oh, whatever I learned in the short term trading actually can be applied to longer term trading. And it's much more accurate because you don't have the noise, you don't have the random events in the market. Like, sometimes in the intraday, you may have big players having different views. They might make different positions against each other, and you get lost in that kind of fight in the intraday. But in the long-term positions taking place on months over years, you don't have that. Very, very rare you have things like that. Then I started building my long-term portfolio 3 years ago. And since then, I've been making consistent gains every year and outperforming hedge funds average every year substantially. For the latest winning streak, I had 8 profitable quarters non-stop. Yeah, I had my first losing quarter in Q4 last year, and then Q1 this year is profitable again. And I was at this year starting to make more than what I would have earned in an investment bank as a vice president. I was working at Deutsche Bank as a quant vice president in their quant team. Later on, I went to a startup to be an engineer, and I'm starting to make more than what I would have earned there or in the investment bank. So I thought it might make more sense to focus more on my time to manage my portfolio well and have more time with family and kid rather than doing the daily grind and neglecting my portfolio where it has some much more sort of P&L impact to my.
Yeah, no, it's really cool. It's a really cool story, and one of the questions I actually had on the back of that, right, is you know I don't think we're quite in the same position, but like I was doing this website TradeInformer alongside my full-time job for quite a long time, for about 2 years. And there's a very noticeable switch, right, from when you know you have a kind of stable income and you're making some kind of side income, and to actually switch from doing something as a, I don't want to say as a hobby because I was taking it seriously, but relying on something, when you know you have that main income stream coming in, and then suddenly you don't, you're sort of it's your mindset kind of changes a bit, and it's not that your product is worse, or in your case, what you're doing is necessarily worse, but I think of trading as actually a very psychological thing, and I'm curious if that switch has made it more difficult for you to sort of run your strategy or do what you're doing basically.
Sure. So I think in trading and in markets, above all else, we need to apply common sense, I feel. And in my case, before I left Deutsche Bank, before I left the startup, I did an estimate. So based on my calculation, the amount of portfolio value I have could have a 3 to 4 years of runway. So which means even if I don't make any money in 3 to 4 years, I still can pay the bills, pay the rent, pay for the cost. So I'm moving and making the switch in a sort of a relative position of strength where I am not pressurized to make money from the get-go and be profitable and makes lots of money to cover all the costs. I could actually just be break even every month, and I still could do this for another 3 4 years. But that's on the bad scenario. But in the normal scenario, I should be profitable and that should cover the cost anyway. It's just how much I have to dip into savings until the account grows large enough to be consistently, I just paying off using dividends or paying off using the profits from the trades. Now, which can be tricky because I mostly take long-term trades. They take many months or couple of years to mature. So I don't sell things that often. So I'll probably need to dip into my savings or trim some of my holdings to pay for the daily and monthly running costs. And I personally hold very little cash, so I'm all invested. So I need to trim my savings for all these costs. But in terms of psychological impact, I think there's a negligible impact. And right off from the start, for the first month, because I'm now doing it full time, I know that I need to move towards shorter term. So I did the two sets of tests. One is a short-term trading for Singapore stocks. One is a mid-term trading for Singapore stocks with a holding period of weeks versus holding period of days. And I've drawn certain conclusions that the short-term trading of days holding period isn't profitable. Holding period of weeks is profitable. And I did those two sets of tests over 10, 20 trades, and I still make I think around 4% return on the capital I allocated to those tests, which is great because in a month I make 4% on the capital, and I got a lot of data points on what niche to focus in while I'm doing it full time, and at the same time managing my long-term position, which is the main bread and butter. But it's just that the cash flow coming in from that is very slow. Like for example, Deutsche Bank, I was holding it for 3 years, then I sold only very recently.
Yeah, no, that's an interesting one. I hadn't really considered that, the sort of cash flow problem. Um, and actually, on that point, right, like on the Singapore indices one, so I've been following some of your writings and things like that. That seems to be something where you're waking up like 1 a.m. to have to trade it. I'm curious if you think that is kind of an edge, just because it might be a market that people are not as focused on, right? Like, personally, I know someone who used to trade the Malaysian index, um, and his theory was just that he had some kind of knowledge of that market without going into too much detail, and it was very. You didn't have that many big foreign investors basically, and the local market was also not that big. Now, I would imagine Singapore is bigger, but is that basically do you think that's a factor in your ability to make profitable trades there?
I think you're spot on that. The reason why I picked Singapore market to do the test for those short-term to mid-term trade is because partly I understand the market best. I've been, trading and investing in the market since 18 years ago. And another reason is because the world's best hedge funds are not going to be playing there. The liquidity there is really tiny compared to, let's say, the UK market, the US market. So you are not going to have the smartest, fastest competition there. So that is why I did my experiments there. If I were to do it in the US market, probably I would lose money in the first month. Yeah. So that's a fair point. Yeah. And but yeah, but that said, I do have investments in the UK stocks market and the US stock markets as well. It's just that I decided to try the experimentation on the mid-term and short-term trading in the Singapore market because that's the one that I'm most familiar with, and I think uh, because of a sort of a relative lack of competition, it might be easier.
Yeah, nice. I always find stuff like that interesting. Like I remember, I think it was last year there was that big case with I want to say Citadel, but I don't think it was them. It might have been like State Street or something like that, and they basically had one of their team left to go to a rival, and then in the court case that came out, they were all trading options derivatives in India because of that was just like a market that was not very tapped into. But yeah, I'm sure we'll probably get back to this kind of conversation later. One of the reasons I actually wanted to talk to you is just on a personal level. One of the reasons I started TradeInformer and sort of became interested in this, I suppose, this industry, is it's almost like a philosophical thing without wanting to sound too pretentious, which is, on a personal level, I can see how someone could trade the markets and do something like, a carry trade, or they could do some kind of arbitrage. I think that would be more difficult with the products that most retail traders have access to. And I can see also how you can do something like, the tail risk hedge that people like Nassim Taleb are always trying to sell. Those things all have a kind of logic to me that makes sense. Whereas technical analysis, which it seems to be, what you're doing, I've always been a bit more skeptical of it. I think there's certain features of it that make sense to me, but yeah, I basically have always found that it's very difficult to distinguish someone who is just lucky, right? You have like 10 million people, so ultimately 100 maybe will get lucky for like 2 years or something like that, versus someone who's genuinely able to run a system where they sort of make money in a way that just doesn't really make sense to me, right? Like the kind of logic of it doesn't really make sense to me. So I'm curious if you like can just sort of respond to that. Like I mean, you obviously believe in this stuff, but is there a kind of underlying logic or reason that justifies that for you?
Yes, yes, I can answer that in a couple of points. Um, First, I think technical analysis does have a quite a bad rep because the barrier to entry is very low. You don't need to have a large pool of capital to build a quant team, to build a hardware compute to get the data sets. You don't have a large team of analysts to do fundamental analysis. So anyone can do technical analysis. So when you have a barrier of entry that low, chances are you're going to get a lot of people who are just not going to do well in it, and people who may claim to do very well, but actually they don't have actual trading records. They're just posting things and not actually doing trading. That's one thing that I observe. And the other thing is that the technical analysis, similar to fundamental analysis, similar to quantitative analysis, we actually have a commonality. And that commonality is we make observations about certain past information. And those observations, time and again, we find that there's a statistical significance that based on the certain inputs of observation, certain output would happen. So, for example, in quantitative analysis, they might do like every time S&P is up in the first month of the year, the chances of being up for the rest of the year is like how many percent? And if it's up first month of the year by a certain percentage, and in second month of the year down by a certain percentage, what's the chance of being up for the rest of the quarter? So all these are statistical observation which links to a certain outcome. And same for fundamental analysis, where you based on the earnings growth, the sector growth, and the revenue and profit margin, you can actually anticipate what's the market reaction to the stock price over a long term. So for technical analysis, it's similar, but it's just that the observation method we use is through the charts and the price data, and not through other attributes like maybe for quants you might do like seasonality, observation of seasonality, and you might do things like, for example, some quants they do like You want to know how good a retailer is doing, you check the parking lots from the satellite images, right? You do stuff like that. But for legal analysis, we observe directly from the charts. And seem like a Renaissance technology, I think they are the best quant firm. And essentially, they take all sorts of inputs from the world and they combine into a model. And based on the model, they know that when they see X, Y, Z as inputs and observation, they know with 80-90% of accuracy that A will happen, and they place their bets. So similarly for technical analysis, where I see certain inputs and observation, I know with a certain degree of probability ABC will happen. And I can give an example. For example, let's say you have a stock that is going between 80 and £100 for a couple of years. Okay, so just imagine some stock that's not going anywhere, and for some reason, in first quarter of the year, it dropped below 80. And after it dropped below 80, let's say it dropped to, let's say, 75, then it in a couple of weeks it bounced back to 80, and then it began trading at 81, 82, and 3. So to me, something fundamental has been revealed. The something fundamental is that the price actually dropped below 80, where it would be a reasonable point to short because it's been ranging between 80 and 100. But instead of the market coming into short and the stockholders who were holding long position, cutting losses and selling, that will accelerate the fall below 80 as a reference point. But instead of the market going lower below 80, the market actually recovers and goes above 80 and start to trade above 80. And then the price get accepted above 80 for a few weeks. So when that happens, I know that fundamentally this stock is not bearish because the stockholders and the participant in this market is not going to sell the stock when it's weak. They're actually holding on to it. So to me, I like to buy this sort of situations where a stock, it can be a gold, it can be a commodity, it can be crypto. I like this sort of situations where an asset class shown itself to have resilience when it's expected to have weakness. So I like this sort of a setup because the risk is very low. And that's how I got quite a high hit rate in 2023. 9 out of 10 of my positions were profitable, over positions. And it's like I only have one loss at the end of the year. So it's not just for stocks, but across commodities as well and across cryptocurrency and Forex as well. So it's more generic in the sense. Yeah. So, yeah.
Sorry, yeah. My pushback on that, right, would be I actually agree with you. So on the if we took the example you're talking about with the stock, right, and it's trading in this range of like, let's say 80p to £1 or whatever, 80p to 90p, and it drops below the 80p barrier, it goes to whatever, 70, 75. To me, that makes sense if you had, let's say, there was like a big pension fund and they had some kind of liability to meet, and so they went, okay, we need to sell our holdings in company X, and because it's such a big position that they're offloading, it will push the price down, and then I can see that it would recover, right? Because that's more like a liquidity event, or rather than a sort of fundamentally driven or event driven, whatever you want to call it, price movement. And so I think that sort of makes sense to me if you assume that markets have like a normal distribution, right? Where there's always going to be a reversion to some kind of range that the stock trades in. But obviously that's not always the case, right? So like if you have some kind of, it could be in FX, could be in stocks. If you have some kind of event like we saw, for example, in April with the Liberation Day, and suddenly everything absolutely tanks, that's not just someone selling off because they need to give some, they need some money for their personal account, or they're a pension fund that needs money. That's like a real event that's kind of tanked markets. And so I guess my point being that in the first scenario of the sort of mean reversion that you're describing makes sense to me, but because the second scenario also exists, it's almost like that would completely wipe out your potential for gains, if that makes sense.
Right, I can answer based on the first scenario and the second scenario. For the first scenario, when the big fund wants to exit the position, if a stock is particularly weak, there will be people who analyze it from fundamental perspective and analyze it from let's say quantitative perspective. They know the stock is weak. They are not going to short it on weakness because there's money to be made. But the reason why it didn't go below 80 and continue going down is because overall the market doesn't think it's weak, so they're actually buying the bargain. which is why when we don't see follow through in this sort of event, it might suggest that actually fundamentally most analysts, most quants are actually bullish on the stock, so they are willing to buy the bargain when it's below 80 or maybe 75. So that's like broadly speaking, that's how I see it. And the second example you quoted on Liberation Day, I actually posted in early March that I exited most of my stock position and indices positions ahead of the Liberation sell-off. And it can't be sort of uh, uh, there's a front run, run because it's already posted to like 1,000+ subscribers. So it's real that I actually posted I sold, and I wrote why I sold my Deutsche Bank shares after holding for 3 years. I shared exactly why I sold my Straits Time Index long position after holding for 2 years, and a couple of other big positions as well. And the way I see it is because I recognize signs that the market is going to tank, and then I trust and I trust my experience enough to know that that is the time to sell. Despite I am very sort of positive on the position I have, I hope it can go up more, but I know I had to exit. And after I exit, true enough, in a few weeks' time, it really tanked a lot. For example, STI, it actually, the Singapore index, it drops almost as much in a few weeks to where I bought it 2 years ago. It's just crazy. And Deutsche Bank shares, it dropped. I would have lost almost 40% of my profits after it doubled in 3 years. So those things could be observed if we care to observe some of the signs. Yeah, of course, when it bounced Liberation Day on the 5th April, on the other end of the spectrum at the dip, I also posted in the newsletter on the 6th April that I think that's where the market will bottom. And then straight away on the Monday, it did bottom, and Nasdaq was the bottom for the day. And it just couldn't be by chance that I keep getting it right. And more recently, I shorted gold, but I know it's going to be hard trade to short, so I shorted it over 3-4 tranches. I think just today it got into a positive territory. It became a profitable trade. So it's not an easy trade, but I shorted it. And when I was shorting it, like very few people actually think it makes sense. But I do see that the probability of it dropping a lot is much more than the probability of it going up a lot from the region I shorted. So I just short it. And at worst, I learned something new. If I'm wrong, and at best I can make some money and also practice a very difficult short trade.
Yeah. So I guess just to go back to my previous point and kind of play devil's advocate as well to what you're saying, right? Like, would you say that what you're doing is significantly different to, a lot of people run EAs, right? A lot of people who are just getting into the markets, they'll often just buy an off the shelf EA, and a lot of the time those systems actually work. They work for let's say a few months. It can actually even be a year or more than a year sometimes, and again, this is my maybe noob understanding of how these things work, rather than yourself. But if you look at how most of them operate, it is basically just a kind of trend line and going, okay, if the price moves below a certain level, it's probably going to revert either up or down back to that level. And the reason that they seem to blow up basically is because there is some kind of event that is, but I don't like using the term black swan because most of the time they're actually not black swan events. But like, let's say something that was more unforeseen, right? And so let's say what you're doing sounds like you're not blowing up. I think that's the distinction, right? So as in most of the time it seems like those EAs work until they don't, and when they stop working, it's not like they've lost 2% down on the original investment. It's like their account is completely gone. And so, yeah, so I don't know, like, is it basically when you're setting up, I guess my question is this, is like when you're setting up to do that sort of trade, are you also setting yourself up to protect yourself so that you're not subject to that risk, right? Of just like, if it's not going to play out or there is a kind of unexpected event, that your account won't blow up yeah.
Sure. So I have a few points on that. It reminds me of long-term capital management. They have the famous mean reversion trade, which blew up very badly because the market went against them and they are so leveraged that they can't unwind. So they blew up instantly. And they are a quant team. They have the best brains, but it's just that I think what you mentioned on the EA, the expert advisor on meta trader and so on, they are sort of like a mini reflection of what happened to LTCM. And that's because they built a model and then expect the model to work, but real world events happened which wasn't even considered in the model when it was built. And then when the model was still followed sort of blindly, like in the case of EA, because as somebody, if let's say I use an EA, I won't know what is it. It's a black box. So I have to trust and keep using it until it goes bust. And then when new events happen that isn't what is the module is built for, there's no sort of a feedback loop and common sense to sort of adjust the risk management portion. And I think that might be why some of the EA can do for a good few months and then they blow up. And that is also part of the reason why many quant teams, they find an edge, but they find that the quality of the signal decay because there are new events that doesn't fit the model so exactly over time. The follow-up point would be, but if we try to go towards a more closer to the ground truth, where we look at the fundamentals of how prices move, and if we try to make our decision based on that, coupled with some common sense on risk management, then we could sort of avert that disaster. I can even give an example, like going back to the example we mentioned earlier on this liberation news. So even though I proposed that Nasdaq is likely to bottom that day, I also wrote in a big disclaimer in the newsletter that, but as a retail trader investor, I don't think we should try to buy the dip because at those few weeks, the hedge fund and institution will be watching the market very closely. If we buy and we are wrong, we can't cut because they will run, but we'll be holding the baby. So even though it was normally the point that you should buy, but I won't even buy it. And at that point, I'm still working full time in a health tech startup, so I didn't buy it. But I'm already vested in some of the US stocks like Nvidia. Nvidia is my largest stock position, so I don't feel a need like I need to get exposure to the US market more than what I have. But that's an example where common sense tells me, even my wife was telling me, hey, the Singapore market tanked so much, I want to buy it. I'm like, well, you're so brave, I won't even dare to touch it, I just want to get out at the high, which I did. But when it was at the low, I didn't have the conviction to buy it because the common sense tells me that it could go either way depending on how Trump decides to handle it. And I can't predict which way. And I don't want to buy something where I have a 50% chance of making money. I want to get into something where I have like at least 80-90% chance of being right.
Yeah. So actually, as a follow up to that, right? A lot of the time when I speak to, let's say, someone who's in your position, or someone who basically is trading their own account and they, are not one of these random people selling a course or something like that. Like a lot of the time, it seems as though it's almost you've done it for so long that it's almost like intuition and intuitive. So, like, do you think that if you which I know you're not going to do, but like if you were hypothetically going to put to some sort of like educational material together, do you think you would actually be able to do that and convey what you do to someone else? Or do you think that what you've learned and kind of accrued over almost two decades is almost like, techne versus episteme, it's sort of like almost like an intuition versus something that you can teach. And with the former, right, is you can't really teach it. You just kind of know it from experience rather than you read it in a book kind of thing. Does that make sense?
Yeah, that's a very good question. In fact, when I was trying to share freely in my newsletters, the YouTube videos, and the coming June meetup in London, I want to share this freely because I learned all these things through quite a bit of hardship, and I want to help. I think trading itself is a net zero-sum game where I make money from market. I don't create any value. But to me, if I can teach some of the younger traders how to save some losses and accelerate their learning, I feel like I'm doing the societal create good value job. Otherwise, I'm not actually creating value by making money in the market. I'm just trading stocks or assets. I don't actually help anyone, right? I don't make society better. But through some of this education stuff, I feel like I'm doing my bit for society. And to answer your question, I can give you an analogy, and you straight away can see why is that so. So let's say you consider Novak Djokovic. He's the number one tennis champion. If he were to write a very thick book of how he win in tennis, and then somebody tries to read it, what will happen? That person probably could get a shortcut in learning how to play tennis well, but he's not going to be professional anytime soon because he still needs to go through the practice and mental rehearsal, the muscle memory of being on the court, how to deal with the decisions, and how to play the game, how to second guess your opponent. So Novak can write all this in detail to his best of his ability, but it still takes somebody to actually practice it enough times to actually be able to do it well. So I feel like trading is something like that. And right from the first day when you enter the market, you're competing with the best. There's no such thing as you're competing locally within your bara, locally within UK, or locally within Europe. Straight away, you're competing with the best in the US from day one. So unless you're good enough in what you're doing, or in other words, good enough in the approach that you have chosen, then it will become very hard to make money because those sharks will actually be the one winning. And being a zero sum game, if you are they are making money, chances are they are making from you than the odds of you making from them because they're really, really very seasoned and really, really very good. Yeah.
Yeah, no, I think the sports analogy is good, right? Like I often look at this. I used to work previously for it's like almost like a outsourced marketing and sales agency for asset management companies selling. I was in a closed-ended funds team, so we used to basically market and sell closed-ended funds. We had an asset manager in house and things like that, so I was quite involved in understanding the sort of active fund management world. And one of the things I've always found about that, right, like obviously in the past, I would say definitely in the past decade, you have this rise of ETFs. And I think one of the main things about ETFs is it makes the average person, one of the key marketing points is it makes the average person feel like they're smarter than a fund manager. So it's, but like obviously one of the main things is that they can say, X% of fund managers don't perform. But like even if you look in the closed-ended fund world in the UK, I think there's 400 to 500 of them, right? So if I think of that in comparison to professional football teams in the UK, right? I think there's in the top 5 leagues, there's probably like 100 teams. The number of people who are actually on the top level is pretty small. But for some reason, in in fund management or in investing or in trading, it's almost like there's an assumption that the skills should be distributed equally, and therefore everyone who's doing it professionally or trying to do it professionally should be amazing, which is like obviously not something you see in any other field. But I'm kind of rambling. So yeah, my next question was actually kind of going to be on like whether you're sort of agnostic to the asset class you're trading in, right? So if I look at some of the stuff you've written, it seems like you're trading equities, you're trading commodities, you're trading FX. So I think you've written about being short on Bitcoin. And to go back to your point on the black box with the EAs, right? I suppose my like skepticism about what you're saying here would be if you're able to trade every asset class and there's just a kind of pattern in the market versus anything else, right? Do you not feel like, I don't know, if you were going from say something you really knew and understood, just hypothetically it might be like technology or something like that, tech stocks, and then you're going to say something like coffee, they're obviously very different. Do you feel confident enough to make trades purely just by looking at the chart and going, okay, this is a trend line over period X, and you're sort of it's almost irrelevant what the underlying product or asset that you're trading is?
Yeah. You raise a good point, and that what you say is true. When I look at different asset classes, I don't really care that much what asset class they are, as long as their price history show a clear sign or to line of sight to profit. Then I am okay to trade it, be it coffee, be it crypto, be it long or short. But what I do look out is liquidity. I don't want to get into something where it's hard to buy and sell because when the markets is not doing well and it's scarce, you can't get out of a position. That's bad. I do look out on that for all types of asset classes, and that's an important criteria. Uh, but in terms of asset classes, I pretty much heavy in commodities now. I think more than 60-70% of my portfolio is in commodities, mostly in long, but I have a short in gold as well. But I can say, at some point in the future, maybe I won't be holding commodities. I don't have a particular uh, love for any asset class. I don't have a particular affiliation for any stock. I just indeed just to make money, and I don't care. Uh, you know, let's say. I think ultimately, if it comes to a day where there's a stock which ethically I won't agree to, let's say it might be selling tobacco, for example, right? Like selling cannabis, for example. But if the chart is saying it's going to make money and it's the best choice out of the other asset classes and stocks or whatever, then I will still buy it. I'll still make a decision based on what I think is likely to be profitable for the portfolio versus the moral grounds of personal love and so on. Yeah. I think we shouldn't, yeah, we really shouldn't try to fall in love with what we are good at. And let's say I were to make a lot of money for commodities, it may be for now because it might not happen in the next 5 years. So I have to be realistic that, I shouldn't always go back to the same stocks or asset classes that I trade just because it made me money like 5 years ago or this year. I should be flexible to look at things with a blank slate and make decisions from start from fresh again.
Yeah. I mean, it's just so different to what I mean, like, I wouldn't say I'm a trader. I'm just like kind of a punter, like I enjoy just almost like betting once in a while, but it's usually very fun. Well, I like to think it's usually very fundamentals driven. Whether or not it actually is in reality is a different question. But like, I find that in those scenarios, right, you can see things which, if you're very familiar with the sector, right, like, so I would say I'm very familiar with basically retail CFD brokers, and there's quite a few of them that are listed. Um, it is kind of funny how you can sort of see different things that would be considered fundamentals, which perhaps the average person would mix. But like, there's a whole other conversation which I'm worried we'll get dragged into. So the other question I actually had was really on like how you actually take positions, because like, do you have? I mean, are you doing this usually with a CFD, or do you use futures, do you use options? Are you just buying cash equities sometimes? All of
Sure.
the above.
Sure, sure. I usually either pick up stocks directly, or in the case of commodities or things like Bitcoin short or indices long, I go through ETFs and ETCs, the exchange traded commodities. I don't like to go through CFD because let's say I want to get a 10,000 pound position. CFD will ask me to pull up with 2,000 pounds and then charge me interest every night for the remaining 8,000 pounds. I rather come up with all the commitment and capital upfront, and that's the most I would lose. In the worst case scenario, I'll lose that commitment. I will lose more than that. But if you go through CFD, it's very easy to keep getting margin calls and keep topping up to hold a position until you might lose more than you initially committed. So I don't really prefer CFD unless there's no other options and I really want to get into an asset, that then maybe I'll just open a CFD account. For now, I don't have that. I do it mostly through picking up the underlying, or in certain cases, I can't actually just short Bitcoin. I expose my position through a Bitcoin ETF. That's the inverse of a Bitcoin.
Yeah. But does that not mean you have to just put up a crazy amount of money as like, if you're obviously you don't have to say how much you're managing, but like, in terms, presumably you would have to, like, to be able to fund your life and live from the returns you're generating. I think it would seem like you have to manage quite a big size portfolio. Whereas obviously if you have CFD, then it's like, at least in theory, the premise is that the leverage would give you access to a larger notional size trade, right?
Yeah, you're right. But the con of CFD is that you'll be fighting against the gravity because you need to make enough to cover the cost of holding the position and the interest. And that sort of give unnecessary psychological pressure for you to make money, and you'll be taking larger risks than you would normally would. So I rather take a risk based on what I can accept, and then in the worst case scenario, I will just keep trimming my positions to fund my lifestyle and my expenses, and that doesn't give me the psychological pressure. Otherwise, if somebody is dependent on the outcome of a trade, for his to pay the rent, pay the bills, that person is going through an unfair disadvantage to the real traders on the Wall Street. And then you don't want that kind of unfair disadvantage. You want to be in the best state as best as possible. I even goes as far as optimizing my diet, optimizing my biohacking stuff to try to make sure my mind and body is the best state as possible as I can, even though I'm 44 years old. Because I need to be mentally sharp. I need to have energy to think sharply, consistently throughout the day, to manage around the clock portfolio. I think all these are factors which are important.
Yeah, no, definitely. And Do you think that what you do or the kind of strategy you run would be like feasible for someone who's managing like a larger size, fully fledged, I don't know, hedge fund or asset management business? Because what I've tended to see with so I don't know if you ever see look at Darwin X. There's a kind of it's probably a bit similar, but also a bit different to what you're doing. But the general premise, right, is that it's almost like hedge fund esque strategies. They find regular people who are good at trading. But my understanding is that they often have a cap on how much you can actually invest because and the cap is often quite low in terms of the account size. It can be like 30 million, which may sound like a lot, but obviously in real world terms is not a huge amount. And it's just because at a certain point it stops working, right? Like the I think it's the underlying is basically just not the liquidity is not there for the strategy to work, or maybe it's a commissions and fees things. I think it tends to be a liquidity thing. Um,
Okay.
and so that's always something I'm curious about, right? Like where a lot of the time I think the average person actually doesn't realize they have quite a big advantage in that sense.
Yeah,
Um,
you're right. You're absolutely right on that, actually. I think there are two angles to look at that. In terms of the type of asset classes and the assets I trade, I think a large hedge fund with 1 billion, AUM can still trade those positions. Like Bitcoin is very liquid, like coffee, like sugar, all these are very liquid, huge markets. But I do have some position, like I got a position in Malaysian stock because it is on the brink of going bankrupt, but I bought it because it has a potential for 50x return. So I allocated 2% of my capital to it. But for hedge funds, they can't because if they buy that, they will be soaking up all the sellers themselves. They can't. I do have position which hedge funds can't do it, but I can because I'm small enough to have the liquidity. But for most of my other position, like if I buy the Singapore index, I buy FTSE, all these hedge funds can do. It's a huge market. Yeah. And Nvidia, it cannot be hedge fund come by Nvidia. They are all in it. Yeah, but but you got a good point that the retailer do have a strong advantage against hedge fund. That is, they have more options to buy and sell from because of the liquidity constraints of a hedge fund. But I think that's a small constraint. The bigger constraint for hedge fund is their annual and quarterly reporting. So a hedge fund cannot lose money. So if they lose money quarterly for this quarter or this year, investors got to draw their money. But for retail investors, it's different. It's our own money, so we can actually take a long-term tenure. Like for example, when I bought Deutsche Bank, I am 95% sure it's gonna make a lot of money, and it did. It more than doubled after 3 years. But during the interim, at one point, it was having a 20-30% paper loss. Okay, well, during the first year because it was on the brink of getting into quite a deep shit at that time in 2022. But to me, it was clear it's gonna be a successful turnaround story, so I bought it. But if you're a hedge fund, you can't actually buy that position and take a 22%, 30% drawdown. You have to account to your portfolio manager, you got account to the risk control team. You might be forced out of the position before it even become profitable. So that sort of constraint will be very real. And particularly for commodities, the cut loss level and range is much larger than stocks potentially. And for hedge fund, you can't easily maneuver around those constraints if you have very strict risk controls that is placed on you because you have to account to your shareholders and investors.
yeah, no, it's
That,
definitely true. I mean, this was something that I experienced not exactly firsthand, but just kind of indirectly with work, and you kind of experience it when you speak to fund managers and stuff like that, where um, to the first point, I would say if you look at say small and mid cap in the UK, there's actually a lot of great companies, but there's so many funds that literally just cannot invest in them, right? Because if you have a market cap of let's say even under a billion for a lot of companies, it's just like there's no point in buying it because because like to take a meaningful position is basically they will own the business and they can't exit it if they need to. Um, and yeah, the other point is 100% accurate. I mean, I think people don't maybe from the outside don't realize the kind of pressure that if you're a fund manager you have to sort of conform and generate returns often over like a medium sort of time frame, which for you as a person would not be that long. Like you might have a 5 or even 10 year horizon on something, but a professional fund manager might be under pressure for very quickly within a year or 2 years,
No
which
way. Yeah, you'll be
yeah,
fine
exactly.
after the
Yeah,
second year.
exactly. You will be fine. Yeah. So yeah. So it's always something that I think is very sort of underrated by actually brokers who are trying to kind of work with clients and teach them and stuff like that, but also end clients themselves, end traders a lot of the time don't really seem to appreciate that that's an edge they have. I think more sophisticated ones do, but yeah. Anyway, it's a whole other conversation. The other thing I was going to ask you was actually on whether you would consider actually turning what you're doing into some kind of I don't know, like family office style thing. I think if you look at, I know two or three people who are in somewhat similar position to you, and two of them, one of them used to be at a uh, almost like a market maker, and then just kind of got bored and went to manage his own money, and then it's a he ended up in a position where he was managing other people's money, and so it's not a massive amount, but it's enough where he's probably in a similar position to you, right? He has enough to live and everything like that, and it's kind of a similar situation with someone else I know. So yeah, I mean, is that something that you would ever consider doing, or you're interested in doing, or are you just content to be more relaxed and deal deal with your own money?
Yeah, that's a natural extension of what I'm doing, and I have people checking with me whether I could manage the money. But the thing is, if I take outside money, it means I got to do more work. There's more admin, there's more accountability, there's more reporting. It means less time for myself, less time for my family, and less time to actually be trading and be working in the markets. And I really like the markets so much that I want to be spending more time with the markets, not with customers and investors. So, uh, I try to solve this problem, but I do want to be able to sort of share what I know so that I can benefit a broader society. So I do this through the newsletter, the sharing, the videos, and what I'm going to do next, I'll announce maybe this afternoon or tomorrow. I'm going to create a new Python package where it tries to plot trend lines that I plot and give buy sell signals that I do. So I'm going to do this open source and free Python package in the coming months, and I'm going to give it out free for people who to use it. And I think that could be a good way to sort of let the broader society benefit from my know-how and experience. Because particularly for hedge funds, they have a legal requirement to only serve customers with £1 million net worth or $200,000 annual income. So a lot and a large part of society can't be customers of hedge funds. I would love to serve this segment, but I don't want to serve them with a customer, business relationship. I just want to spend more time with markets, with my family. But I could sort of model what I know into a software and open source and free, and people could just use it as a guide to, see, let's say, some quant or fundamental analysts like, oh, I want to buy Ocado. What does this model thinks that Ocado is doing now? Is it bearish, bullish, or neutral? The sort of additional data point, additional set of data point. Yeah. So will be doing that next.
Yeah, no, that sounds really cool. I mean, final question for you would be whether, and I know we've talked about that, the fact that maybe this is something you have to just experience firsthand rather than learn from reading. But are there any things over the past, say, 2 decades that you've been doing this where you think actually if someone had just told me don't do this or try this, that it would have, I don't know, it would have shortened the time it took you to reach the point you're at now?
Yeah, it would. But there's a caveat to it. The caveat is that I think different people tend to do well using different approaches. Let's say I feel like I'm doing well and I sort of can do a long term trading, but some people can't hold positions for more than a month, right? So they don't have the patience to actually water the plant and hold it for a couple of years. So in that case, you can't force a person to trade in a way which is counterintuitive to his personality. It's just not going to work. So for me, if somebody were to tell me, I came from your future, I'm you from your future, and in the future you will have found that taking long term position is the way to go. Then that will save me a lot of time. It will save me 5 years or more, right? Then I'll be happy to do that. But let's say if I'm somebody from the future, I know how hard this journey will be. I'll probably go back and tell myself 18 years ago, just don't start it. It just don't bother. It's really not worth it. Seriously, it's not worth it because you go through a lot of ups and downs personally and your family as well because you have losing streaks and you affect your family as well, right? It's gonna not be just a one person thing, but the people around you. It's got there are a lot of family support involved for me to get here. But if I were to do it again, I'll probably tell myself just don't bother. You can have a much easier life and happier life by not being in the markets, or maybe just buy ETF, dollar cost average, or do something else. Just don't trade it yourself. It's not worth the effort.
Yeah, that it's funny. The guy, one of the people I know who is at a he's at a sort of quant trading firm. He's like it's like one of those pod firms, and he was basically just like he's a really clever person. He has a PhD from a really good university in maths, physics. I can't remember which, and he's spending all day doing this quite complicated stuff. And I had a beer with him, and he was saying, it's like so much effort just to get 10% per year. Like so much work just to try and get 10% per year, and that's all you really have to do. Like, is it worth it? Should I have done something different? So I think you're not the only one who's feeling that way. But yeah, thanks so much for doing this, Ken. It was really good to speak to you. If you're watching this and you're in the UK, I think next month, we're recording this on May 15th. I think next month Ken is doing a meetup for people in London. So if you're interested in trading, or if you just want to meet Ken, then definitely go along to that. And thanks again for doing this. Hopefully we can catch up again at some other point in the future. And good luck with everything you're doing.
Thank you so much. Happy to be here. Cheers.
Yeah, cheers, man.